Once more, we are saying you guys should drop some scissors in the chat, some likes in the like button, and let us cover this. SI is upwards of 2,000%. GME is in $100 trillion bubble waiting to pop, and DTCC is attempting to crash the entire market to socialize losses. Change my mind. Too long didn't read. Believe that naked shorting has allowed GameStop circulating shares to number above 1 billion, with a minimum short interest percentage of float to be 2,000%. Thus, it can be concluded retail likely owns upwards of 500 million shares, and the financial impact is likely upwards of 100 trillion. DTCC came to this same conclusion around mid-March and is now actively taking steps to crash the entire market, allowing them to socialize losses to other major players in the market. Now, socialize is a scary word here, but mainly it's just to kind of like have everyone share the bill. And this is the easiest way to understand, is kind of like there's going to be a big check later for someone who bought too many margaritas, and right now DTCC is trying to say, hey, usually we go Dutch, but this time let's just split it evenly down the line, right? Everybody pays, and therefore, if everyone pays, even the innocent ones that didn't decide to go short and do all these manipulation tactics, they are going to be much more incentivized to snitch on the other hedge funds here. Okay, so disclaimers, this is not financial advice, you guys understand this. So we have a pretty well-defined structure here. Recap, DD on DTCC, and then the thesis argument. Here's a quick recap. How did it come to this? To begin, a quick summary of the previous 6 months. It starts with two opposing sides that cannot agree to disagree. On the short side, GameStop is viewed as a dying brick-and-mortar company. Melvin Capital and many other major players heavily short GameStop, likely even installing several GameStop board members to guarantee the collapse. However, long players see deep effing value in GameStop, using the famed and feared buy and hold tactic. Also great for taxes. This is going to be putting those players, retail investors, on the long side. And those shorts are now in serious trouble because they have infinite loss potential. This is just getting back to our roots of understanding exactly what's going on with this GameStop situation, right? Infinite loss versus finite loss. That's a pretty big difference here. I believe as early as fall 2020, Melvin realized their firm might be on the line. This situation worsened for them in December and January run-up that ultimately was Melvin Capital's death sentence. But everyone works for someone, right? Enter in Citadel, right? This is Big Papa Citadel coming in. Kenny G, he is in many of these thumbnails. I'm sure the two of us are good friends if we just had a chance to talk to each other. I suspect... Jokes, by the way. I suspect sometime in the December and January timeframe, Citadel realizes that they may be looking at tens to hundreds of billions of dollars in losses due to Melvin's short position. So what does our boy Kenny G do? Well, he takes a calculated risk to reduce the negative impact of Melvin's short position by allowing a fake squeeze to occur, causing a retail sell-off. Now we're going into the alleged conspiracy realm, right? This is Citadel allowing the gamma squeeze in January to occur. With the combined powers of price manipulation, media control, and contacts throughout the financial world, what could possibly go wrong? Well, some guy who's not a cat didn't sell, and apparently he wasn't alone. Furthermore, GameStop's situation dominated the media and brought in millions of new retail apes, and themselves included, as they had zero experience and interest in stocks. So if you've learned like more than you could imagine learning in this short period of time, throw some rockets in the chat right now. Throw some rockets down in the comment section, because personally, I feel like my knowledge of the financial world has just exponentially grown. And luckily, thanks to those of you in this Moon Platoon hive mind, we are learning from each other. Lifelong learning starts here. That subscribe button is where you can start your lifelong learning journey. Furthermore, GameStop's situation dominated the media and brought in millions of new retail investors like this. I believe this also had another important effect. Citadel now knew the entire multi-hundred billion dollar firm was on the line, and Citadel no longer needed to manage risk. We see this in sports all the time. When a team is already losing a game, they will often play all-out offense, because what is the difference between losing by 1, 2, 10, 50 points, right? This is kind of the same mentality on the other side. When you guys saw 80% down in your portfolios, like I did, buying at 250 and dropping all the way down to 40, I was like, well, what's the point of losing 20% more? So that's the thing. If you're losing already, How is 20%, 80% down different than 90% down, different than 100% down? Just mentally. Of course, financially there's a difference, but mentally, right? I haven't seen Trey's latest video yet, but I will give it a sec. In an outcome the game is lost, a similar philosophy can be applied to finance, since what is the difference between owing 500 billion, 50 trillion when the firm is only worth 300 billion? In any of the outcomes, the firm is lost. Throughout February, we saw the effects of hundreds of millions of naked shorts entering circulation, bringing the price down from about $300 to $40. During this time, we see aggressive media campaigns aimed at distracting potential investors from GameStop and causing investors already long on GameStop to sell. Remember, Silver, Weed, RKT, and many more. This game of smoke and mirrors lasts until the middle of March, when DTCC can peer into the void and see exactly what the situation is. I think what they saw terrified them, and now they are fighting to not hold the entire bag. Enter the DTCC, right? This is what the DTCC looks like. Actual picture, unrelated picture. Oh, whoops. Let us start with a copy pasta definition that they took from Investopedia as an easy to understand. Before you read this Investopedia copy pasta, they're like the purse strings holders of the purse string. If you need money, you go to a bank or go to a Melvin, right? And then if Melvin or a bank needs money, they go to the DTCC. The Depository Trust and Clearing Corporation is an American post-trade financial services company providing clearing and settlement services to the financial markets. It performs the exchange of securities on behalf of buyers and sellers and functions as a central securities depository by providing central custody of securities. What does that mean? Well, to answer the following is taken from Who Really Owns Your Money, an article written by Anthony Freed. DTCC is the biggest bank in the world that you have probably never heard of. But if you have subscribed to this show and rung that bell button, 100% you've heard of it. DTCC's catalyst coming up soon is going to be humongous. They happen to be the registered owners of 99% of all paper. Scary, but true. The DTCC retains registered ownership, while you as the peasant investor have the designation of beneficiary of the instruments. So thank you so much for benefiting us, your Royal DTCC Highness. This begs the question, WFT is a beneficiary owner versus a registered holder, taken from the aforementioned article. Registered holder, here's some definitions, right? We don't have to go through this. So the most important part is that no one owns anything. Well, that doesn't make any sense. Well, there's a good reason, and Freed covers that as well. With electronic trading, it is impossible to make timely changes to registered ownership of the paper. Oh, so in order to speed up transactions, the DTCC was created to keep all the assets of the stock market under one owner. Well, that makes sense. And surely an organization that is the sole owner of 99% of the stock market would be highly regulated and extremely transparent to ensure peace of mind for all beneficiary owners, right? I mean, that must be the case, right? Right? Personally, I do not believe that the case after watching the Wall Street conspiracy movie that has been posted previously. I guess after watching a movie, they don't think that a movie titled The Conspiracy, they do not think anymore. The DTCC is and has always been very loosely regulated, with a history of being culpable regarding naked shorting practices, right? So once more, let's just read this bold part. Critics blame DTCC, noting that the organization is in charge of a system where the naked short selling happens, alleging that DTCC turned a blind eye to the problem. Oh, I missed in the super from E. Jean, working on a new Meatball art piece, and with the DD, why is no one talking about Apex clearing? They fund a bunch of the brokerages. They do. They fund SoFi, and they fund WeBull, right? I just filed my taxes, so I know that for sure. Yeah, we can talk about that in just a second. In July 2007, Senator Bob Bennett, Republican of Utah, suggested on the Senate floor that the allegations involving DTCC and naked short selling were serious enough to warrant a hearing. The Senate Banking Committee's chairman, Senator Christopher Dodd, indicated that he was willing to hold such a hearing. No such hearing was ever held, however. So the DTCC has been in trouble. It's a little naughty pants, as it turns out, having the biggest bank in the entire world. So here is thesis statement number 1. 2,000% SI minimum. Over time, eventually, math and logic will balance the equation. The user be biased. So how the heck are we getting 2000% SI as a conservative estimate? Well, it all starts with these daily glitches, and we talked about those glitches earlier. To add some credibility here, they are degreed in both electrical and computer engineering, so they come from a technical background. Often it is useful to look at complicated puzzles with a black box approach. I will make the following assumptions in doing so. There is significant evidence to support synthetic shares being created. I mean, this is just already fact, right? We've already talked about this. This is not allegations. They don't give a single F how they are being created. That's that they are being created. And most importantly, it's not even illegal if you are doing it with non-malicious intent. Citadel is a financial beast with multiple different arms that by law must be firewalled, likely meaning that no electronics traffic exists between these arms. Getting a little technical, but stay with us. One arm of Citadel might be responsible for creating synthetic shares, might have some connection to the hundreds of millions of shares in dark pools, while another arm is responsible for closing the IOUs. As a reminder, we have ATC and non-ATC OTC pools, ATS and non-ATS. This 2 billion of shares of AMC and 500 million shares of GME are not in the dark pool version of the OTC trades. As a reminder, this transfer of IOUs cannot be done internally within Citadel due to the firewall. Thus, this transfer must hit the open market in some manner. Once again, they don't care how it's happening, just that there's reason to believe it is happening. Computers are incredibly stupid. They make up for that by being able to do simple tasks unbelievably quickly and accurately. This is what gives us the illusion of being smart. I feel like this person's racist against computers. How dare you say that? Some computer somewhere saw the traffic accounting for the transfer of IOUs and said, I take number from here and put it there because that's what it is programmed to do. It just so happens that it places numbers was in TOS in plain sight to all of us retail apes. Diagram to illustrate the solution. All right, so we have pretty picture, too big, pretty picture to understand what is happening with all of that explanation here. We have Citadel as a large box here and the market, right? We have multiple different arms of Citadel right here. One of them creates the synthetic shares. The IOUs go into the market. We've explained this on Whiteboard multiple times. I also just explained it to the private live stream that we have on monthly basis with the Space Legend and the Gorillionaire tier memberships. But we have these synthetic shares created here. They go into the market. The market traffic data goes in TOS and other data collection platforms, reads the IOU traffic and automatically reports it. When they leave the market, they go into an IOUs for synthetic shares, await closure on the open market here on some other arm of Citadel. There is one arm of Citadel saying, here, look at these synthetic shares. We'll find some way to do it, to find out where to borrow from later. And there's a firewall setting up directly between these two arms of Citadel. So now that we have presented a theory on how this is working, let us test this theory against the 94 million share glitch from February. If the theory is correct, one would expect to see the following: unusually high buy pressure in the days after the February 22 glitch, and this buying pressure should continue until roughly 94 million volume has been recorded. So here's that 4-hour chart. We've actually seen this before. So in here, I think this is, let me read a little closer. This is the end of February right there. We see a combined 94 million volume between February 22 and the 24th. And then it appears there was increased buying pressure here. The stock only more than doubled in 3 days. Then a big a spike here that broke downward appears to be the effects of FOMO as these prices do not hold, and then a period of consolidation roughly where 94 million buying pressure originally ran out on February 24th. This is a good time to note that we are actually upgrading our charts soon, right? We've been using WeBull so far, but very soon, maybe starting as early as tomorrow, we're going to have a brand new technology to up our game. So starting on tomorrow, you might see some changes, new indicators, as well as new software. I don't know about you, but my confirmation bias just did a 6 to midnight. In this chart, we see immense buying pressure push the stock from roughly 45 bucks to reconsolidating above $100 after the buying pressure wore off. Furthermore, we see that buying pressure fall off a cliff since 94 million total volume is met. In their opinion, it's too dang convenient to be a coincidence. So, right, once more to explain this in ape language, right? We have buying pressure that pushed us from 45 bucks to over $100, okay? And then we see buying pressure fall off a cliff, right? The FOMO brought us up and then put us down. However, there's still 94 million volume on the following few days where the price does not jump accordingly. You see how the volume here, barely any volume. We should combine 94 volume between 22 and 24th. Right? In their opinion, it's just too dang convenient to be a coincidence. The major counter argument that they see, if there are over 1 billion shares and counting currently waiting to be closed out, why has the price not gone to 1,000 already? They believe that the theory can tell us about the number of shorts that need to close. I think that it tells us also about the timing. It tells us absolutely nothing about the timing. Also, we have not had stellar success as a community with predicting the timing. So personally, they're not going to speculate on it. But what have we seen in the charts since March 23? Well, the average daily volume from March 17 to 23 is roughly 15 million per day. Interestingly, the average daily volume since that 634 million glitch has almost been 37 million. Furthermore, if you look at the price change from close to close, the price moved from 181 on close to 181 close on March 26th. So these are 3 days of differences, but only 75 cents of actual range. Interesting that we are right below 182, as this is where the glitches have come in at. So remember how the Russell 2000 was shorted? Thus, there was buying pressure coming in from somewhere to cancel out the operational shorting done by the Russell 2000. They believe the greater than 1 billion shares waiting to be purchased is the source of this buying pressure. So as a summary, if they are correct and these glitches are giving an opportunity to see short positions attempting to sneak through the market, they believe they're running total of roughly 1.2 billion shares, right? So we run that math real quick, 2,000% of SI afloat at minimum, and then we do some non-conservative math. This was the SI afloat, and then 1,400% SI of outstanding shares at minimum. Following DD has a more precise calculation of 2,600% SI of float. As we've seen before, we've been tracking the float percent of float, short percent of float on FINRA, and that is something that I want you guys to track with us, is that if these numbers are actually being obfuscated based on this evidence, exactly how soon is this ticking time bomb going to blow up? And how likely are we going to be on the right side of it when it does, right? This DD is getting a little long, so I want to be able to cut it off right here. However, there is plenty more to cover, so I'm going to include it in the description of this video. Thank those of you who are on this tier and this tier and this tier for supporting the show. I will be updating these names tonight, so if you guys have not yet pressed that join button or that Patreon link in the description, now is a great time to do it because you'll be on this list for 1 whole week. I really do appreciate you guys, and we'll see you in the money.